Hello everyone, welcome to commercial arithmetic class. So we have completed the third unit, that is commission, brokerage and discount. So in today's video we will begin with the fourth unit, that is life insurance. So first let us understand what is insurance. So insurance may be defined as a corporative device to distribute the loss to an individual by pooling or averaging out of a common risk. So the heavy loss to an individual or to his property from unpredictable and uncertain contingencies as death by accident, illness, disability, unemployment or natural calamities such as fire, flood, earthquake, etc. is minimized by insurance. So in modern times insurance is becoming increasingly important, and also its usefulness is appreciated a lot by the people, so much that it is now possible to insure anything which comes under the term risk. So provided of course there exists an insurable interest. So there are persons who are benefited by its safety. Now the person who agrees to insure themselves against risk contribute comparatively small sums of money called premiums. So in return for an assurance from the party which undertakes to compensate their losses if incurred. So here the person who gets insurance done has to pay some amount which is called as premium, for which the company or any insurance office or any insured person will compensate their losses if in case there is some accident or death, or there is death due to natural calamities. So the contract between the insurer and the insured is called as policy of insurance. So there are two types of insurance. One is life insurance and the other one is general insurance, which includes fire, marine and accidental insurance. So now let us study life insurance. So it is a contract under which the insurer agrees to pay a certain specified sum to the insured on the death of the latter or on his attaining a particular age, whichever is first, in consideration of a periodic payment called premium. So the amount of premium payable depends on the sum assured, the period of policy, the age of the person, the mode of payment, that is it may be yearly or quarterly or monthly or half yearly. So depending upon these factors the amount of premium is based on, and also it is based on the type of insurance desired. So general insurance is governed by contracts of indemnity. The insurer undertakes to pay to the extent of loss suffered by the insured through contingencies such as fire, marine, accident, etc. So now let us understand the terms surrender value and paid up value. So when a policy holder wishes to discontinue paying premiums, he may either surrender the policy to the corporation for cash consideration, or he may convert it into a paid up policy. So if the policy is surrendered to the corporation, then he gets an amount called surrender value, which depends on the total annual premiums paid and the type of the policy. So the surrender value is granted only when the policy has been in force for at least 2 full years, or 1/10 of the stipulated number of premiums are paid, and the amounts to a minimum of 30% of the total amount of premiums paid, excluding the premium of the first year. So in the case of paid up value, the policy holder gets an assurance for a proportionate amount of the sum assured and is free from the payment of future premiums. Here also the policy has to remain in force for at least 2 full years in order that it may be converted into paid up policy. So we can calculate paid up value as T divided by N into policy amount, where T is the total number of premiums paid by the holder and N is the total number of premiums specified in policy. And claim is equal to insured value divided by total value of property into net loss. So we will be using this formula throughout the insurance unit to solve the problems. That is, claim is equal to insured value by total value of property into net loss, and paid up value is total number of premiums paid divided by total number of premiums specified in the policy into policy amount. So now let us study the important definitions, that is over insurance and under insurance. So insurance of a property for more than its value without any fraudulent intention may also be taken. The property is then said to be over-insured. But the insurers do not pay more than the actual loss suffered in the event of any damage or loss of the property. So properties need not to be insured to their full value. Cases of underinsurance, where the policy covers only a part of their full value, are also prevalent in business. So the insurance is supposed to be his own underwriter for the remaining value not covered by the insurance. In the case of loss, the insurer or the underwriter pays only a proportional amount of loss sustained depending on the sum insured. So here, in case of over-insurance, the insurance of a property is actually more than what its actual value is. So in such cases we can say it is over-insured, and under-insurance means the value of the property is not completely insured, 100% it is not insured, whereas only a part of its full value is insured. So in such cases it is said to be under-insurance. So over-insurance and under-insurance is an important definition, and it will be asked in 2 marks question. So in the next class we will begin with the problems based on life insurance as well as general insurance. So that's it for today's class. Thank you.